Warren Buffett's net worth. How billionaires built his fortune. Hello guys, welcome to our channel. In this video, we will talk about Warren Buffett's net worth. So before starting this video, please like and subscribe to our channel for future updates. Warren Buffett is considered by many to be the best investors of all time. Rupert Hargreaves examines how much Buffett is worth and how he made his fortune and listed the stocks in Buffett's portfolio. Warren Buffett is considered by many to be the best investor of all time. When he set out on his own in the mid-1950s, investors entrusted him with just $100,000, around $1 million today, of their capital. Over the past 70 years, he has grown this capital into a conglomerate with just under $1 trillion of assets. Buffett started investing at the age of 11 years old, buying 6 shares of Citi's Service preferred stock, 3 for himself and 3 for his sister at $38 per share. He made a small profit on this investment and built several other businesses. He filed his first tax return at just 17 years of age. It was for the 1994 calendar year. He would earn $592.50, more than half of it from a paper round, the rest from investments. He paid $7 in tax. The young businessman attended the University of Nebraska before moving to Columbia University, where he met his mentor, Professor Benjamin Graham. Graham essentially wrote the book on value investing and managed by his own investment firm, which the young Buffett joined when he left university. Unfortunately, Graham wound up the venture a few years after the young entrepreneur joined, and he was soon back home in Omaha. Soon afterwards, a group of family and friends asked Buffett to invest their savings into the stock market. The Buffett partnerships, as they came to be known, earned a 31.6% annual return before fees from 1957 to 1968, compared to 9.1% for the Dow Jones Industrial Average. Buffett used a similar investment strategy to the one pioneered by Graham. The Warren Buffett portfolio and the rise of Berkshire Hathaway. Buffett started buying shares in Berkshire Hathaway for his partner's portfolio in the early 1960s. At that time, Berkshire was a struggling textile business. Its peers had a much lower cost base, so they could undercut the firm on price. As losses mounted, the corporation's market value fell below the value of assets on its balance sheet. The investor wanted Berkshire to start closing its manufacturing facilities and return the cash to its shareholders, which would have produced a fat, risk-free return for all of its shareholders. However, Berkshire's management declined to follow his plan, so Buffett decided to take control of the business himself. Buffett used Berkshire's capital to buy up other firms, mainly companies in the insurance sector. In 1967, he bought Omaha-based insurer National Indemnity Company for $8.6 million, giving him his first foothold in the industry. Not only was National Indemnity a well-run, profitable insurer, but it also owned an investment portfolio. It owns insurer Geico, battery maker Duracell, restaurant chain Dairy Queen, BNSF, one of the largest railroads in the US, and a utility giant, Berkshire Hathaway Energy. That's all alongside a $300 billion portfolio of equities. Warren Buffett's net worth exceeds $100 billion. At the same time, Buffett has built a huge fortune for himself. He is the 5th richest person in the world. The exact position fluctuates, but he's generally in the top 5, with a net worth of $112 billion. Virtually all of the Buffett's wealth is tied up in Berkshire Hathaway stock. Since he gained control of the business in 1965, the shares have returned 20.1% per annum compared to 10.5% from the S&P 500. The top stocks in Warren Buffett's portfolio. Buffett's investing style can be defined by one of his best-known quotes. Rule number 1: never lose money. Rule number 2: never forget Rule 1. Since the 1950s, investor has sought to find investment opportunities with a low chance of failure but high return potential. Buffett seeks to minimize the risk of failure by sticking to companies in sectors that he knows well. Risk comes from not knowing what you are doing, he says. He likes to own companies with an enduring competitive advantage, such as a well-known brand or substantial economies of scale, and will not pay over the odds for any business. A value investor prefers to buy when other investors are selling. In 2008, when the global financial sector was teetering on the edge of collapse, Buffett invested $5 billion of Berkshire's cash in Goldman Sachs at extremely favorable terms, which would have been impossible for an ordinary investor to access. The bet eventually yielded a profit of more than $3 billion for the conglomerate. Around the same time, he plowed cash into Dow Chemical, Bank of America, and General Electric. Despite this impressive bet, Buffett does not try to time the market or speculate on the price of securities. He believes that investors should approach buying a stock with the same mindset as if they were buying the entire business. He has encouraged others to own your stocks as an investment, just like you would own an apartment, house, or a farm. Look at them as a business. What do you think of our video? Let us know in the comment section below. If you enjoyed this video and want to hear from me again, hit that subscribe button before you go. Thank you.